Good morning, it's Arion with Investing Architect, and today I wanted to walk you through our exact process for analyzing an investment property start to finish. So let's dive right in. So we've got a property here that is in Cypress, Texas. I actually analyzed this earlier in the week for a client. It's now sold, but it will do for the purpose of illustrating how we went about the process of analyzing it. So the very first step in our process, we've got to write down some key pieces of information in a notebook. So we want to know the address of the property. We want to know the square footage, in this case 1392, just under 1400 square feet. When was it built? The name of the subdivision, right? How many bedrooms, bathrooms, and garages are there? So this one's a 322. And finally, we need to know what are the property taxes for the year in this property and the homeowner association dues. So we write down all that information: address, subdivision, square footage, year built, how many bedrooms, what are the taxes, what are the homeowner association dues. We write that down because we're going to need that data later when we put it all together. The second step in the process is we have to determine what is the fair market value of this property for lease, or in other words, what will this property lease for when we put it on the market to find a tenant. So the way that we determine that, the proper way to determine that, is to run a comparative market analysis for lease, meaning we want to pinpoint the property in a map and we want to say, okay, what do properties similar to this one rent for within a half-mile radius, right, that are similar build, similar size, similar age, right? And I have completed that here for purpose of moving a little faster, right? And what we have here is, what we'll notice is that rents there go from $13.45 on the low end to about $15.60 on the high end. So what we want to do is we want to figure out what is the average. So the average rent for the area is about $14.13, and what you'll notice here is that really the midpoint is closer to about $14.25. And this is where the science stops and the art begins, right? Because what you have to be able to determine is, this is a spectrum, right? So it goes from simple starter type home to more upgraded, more higher end finishes. So what you have to determine objectively is, where does this property fit in that spectrum? Like, is it a average type property, in which case it should be about here? Is it more of a premium type property, or is it less than average, right? In this case, this property is a little better than average. It's got some upgrades in it that are nice. So, but we also like to be conservative. So in this case, I would determine the rent to be about $14.25 per month. So we write that down in our notebook as well. The next step is figuring out, well, what is this property worth for sale? Now, why would we want to calculate that? Well, the reason to calculate that is we don't want to overpay for the property under any circumstances, right? So we want to make sure, what is this property worth? Because if we're financing this property, we want to know that when we go to get an appraisal on a property, that it's going to appraise for the price that we're buying it for. And nobody likes to overpay. So I've run that analysis as well here. And what you'll notice, and again, on these analyses, you always focus primarily on sold properties, so properties that have already closed, right? You don't want to focus primarily on active properties, because all that tells you is what your competition is, but not necessarily, what you are likely to get on the open market. So what we notice here is that the average price, adjusted sold price for this area is about $155, right? And in this case, this property, they are asking $155. So the property is priced correctly, right? So we write down that the fair market value of the property is $155. So now it's time to put it all together in our model. So I've already kind of filled out some of the information on the property, the property address, the subdivision name, square footage, bedrooms, bathrooms, year built, what school district is it zoned to, it's a single family home in Cypress, and some comments from the MLS. So let's put it all together now. So they're asking $155,000 for this property. We determined that the fair market value is also $155,000 for the property, and we're going to run the analysis in the beginning at that price just to see what the numbers look like. Right, so here we're assuming a 25% down. We can do it with 20 as well. And the interest rate that we saw yesterday, as early as yesterday, was 4% that we could get on an investment property. And also this model assumes that you are holding the property for 10 years, meaning you don't have to sell it in 10 years, but for purposes of analysis, you always have to establish some point at which the capital returns back to you. We're estimating closing costs at 3%. This could be higher or lower depending on the interest rate that you pick. We're assuming that there's no make ready here, meaning that the property is rent ready. We're not going to do any work or spend any money to get the property ready for rent. This could change, obviously, if the property needs paint or carpet, or that figure would go here. The appreciation rate that we're assuming is 3.23%. That's essentially inflation. In the market that we're looking at, the appreciation rate has been far higher than 3%, but we like to be conservative. And the we're assuming cost of sale of 7%, so commissions and title policy whenever we sell it. And also we're assuming that the rents and expenses both go up at 3% per year rate. So we estimated the rent conservatively at $14.25 per month. The property taxes on this property were $43.22. Property insurance in our area typically runs about $100 a month or $1,200 a year, and the homeowner association in that property was $350 a year. Okay, so we're estimating maintenance and repairs at about 5%. This varies based on age. The older the property, the higher your maintenance reserve should be. In this case, if we're running the property for an investor that's going to self-manage, we would set the property management to 0 because they wouldn't have a property management expense. But if we were to manage it for them, typically the rate that we charge is about 8% of the gross rents. Finally, the leasing fee is 1 month's rent, but the average tenant that we place tends to stay 2 to 3 years. So we're estimating leasing fees at about 50% per year, and the tenants pay all utilities. So the landlords don't pay any of the utilities here. So what's happening here is that the model is now auto-calculating the net operating income, which in this case is $8,848. That's the income that the property would produce if it were free and clear. It calculates the cap rate and the adjusted price to rent ratios, what the annual cash flow will be on the property, and what is the internal rate of return for the 10-year hold on the property and the cash on cash return. Right? So in this one sheet of paper that we actually send to our clients, all that data is compiled, right? And it tells them what are the operating expenses, what is the net operating income, what will it cost you to service the debt, what is the cash flow on the property, how much are you paying towards principal each year, what is the appreciation return that you don't realize until you sell, and what is the total return. It also tells them what their depreciation deduction is, which they can then use to calculate the tax benefits on the property. So when you look at a 10-year hold, the way this property is playing out is you're putting in $35,600 to purchase the property. These are your cash flows for years 1 through 9, and then on year 10 you sell the property, and this is your net. These are your net proceeds. So essentially, in 10 years, you're getting 3x return, and this stream of cash flows translates to a 16% internal rate of return on the property. So that is our entire process for analyzing a property. Now,